Hey everyone, and welcome back to the channel. Today, we're diving into a topic that affects every single one of us living and working in Canada: taxes. I know. The word tax can sound intimidating, maybe even a little boring. But stick with me. Understanding how the system works is a superpower. It can save you money, help you plan for your future, and honestly, just make you feel a lot more in control of your finances. So grab a coffee, get comfortable, and let's demystify Canadian taxes together. First things first, why do we even pay taxes? Well, think about all the public services we use every day: roads, hospitals, schools, parks, public transit. And our social safety nets, like employment, insurance, and the Canada Pension Plan. Taxes are our collective contribution to building and maintaining the society we live in. The money is collected by the government and then allocated to these essential services. There are different types of taxes, like sales tax, which you pay on goods and services, and property tax if you own a home. But today, we're focusing on the big one: income tax. So, who has to pay income tax in Canada? Generally, if you are a resident of Canada for tax purposes, you have to file an income tax return and pay tax on your income from all sources, both inside and outside of Canada. This includes income from employment, self-employment, investments, and even certain government benefits. Even if you're a non-resident, you might still have to pay Canadian tax on income you earn from Canadian sources. The key agency handling all of this is the Canada Revenue Agency, or the CRA. You'll get to know them pretty well. Now, let's talk about how income tax is actually calculated. Canada has a progressive or graduated tax system. This is a really important concept to grasp. It doesn't mean you pay a single flat percentage on your entire income. Instead, your income is divided into different brackets, and each bracket is taxed at a different rate. The more you earn, the higher the tax rate on your topmost dollars. Let's break it down with a simple hypothetical example. Imagine the first tax bracket is for income up to $50,000, taxed at 15%. The next bracket is for income from $50,001 to $100,000, taxed at 20%. If you earn $70,000, you don't pay 20% on the whole amount. So, you earn money, and your employer usually withholds tax directly from your paycheck. This is why your take-home pay is less than your gross pay. They're basically prepaying your estimated taxes to the CRA throughout the year. But how does the CRA know if you've paid the right amount? That's where filing your tax return comes in. The tax filing deadline for most individuals is April 30th each year. If you or your spouse are self-employed, you get a bit longer, until June 15th. But any tax you owe is still due by April 30th. Filing a return is your chance to settle up with the government. You report all your income for the previous calendar year, from January 1st to December 31st. To do this, you'll need some key documents, often called tax slips. The most common one is the T4 slip, which you get from your employer. It shows how much you earned and how much tax was already deducted from your pay. If you have other sources of income, you might get other slips, like a T5 for investment income or a T4A for pension or other income. It's your responsibility to gather all these slips and report all your income. But filing your taxes isn't just about paying up. It's also your opportunity to reduce the amount of tax you owe. This is done through deductions and tax credits. People often use these terms interchangeably, but they work differently. A tax deduction reduces your taxable income. Remember our tax brackets. Deductions lower the total income that gets subjected to those tax rates. For example, contributions to a registered retirement savings plan, or RRSP, are a common deduction. If you earned $70,000 and contributed $5,000 to your RRSP, you would now only be taxed on $65,000. This can be powerful, as it might even drop you into a lower tax bracket for some of your income, saving you a significant amount. Other examples include childcare expenses and certain employment expenses. Tax credits, on the other hand, directly reduce the amount of tax you have to pay. They're calculated at the lowest tax rate. There are two types: non-refundable and refundable. Non-refundable tax credits can reduce your tax payable to zero. But you don't get any money back if your credits are more than the tax you owe. The most fundamental one is the basic personal amount. This is an amount that every Canadian resident can claim, acknowledging that a certain level of income shouldn't be taxed. Other non-refundable credits include those for medical expenses, donations to charity, and tuition fees. Then there are refundable tax credits. These are the best kind. If these credits are more than the tax you owe, the government actually pays you the difference. A great example is the GST/HST credit, which is designed to help low and modest income individuals and families offset the sales tax they pay. Another is the Canada Workers Benefit. So let's recap the process. You earn income, and taxes are likely deducted at the source. After the year ends, you receive your tax slips. You gather all your income information, along with any receipts for potential deductions and credits. You then fill out your tax return, calculate your total income, apply all eligible deductions to get your net income and then your taxable income. Then, you calculate the federal and provincial tax you owe based on the tax brackets. Finally, you apply your tax credits to reduce the tax payable. After all that math, one of two things will happen. If the total tax you owe is less than the amount that was withheld from your pay throughout the year, you'll get a tax refund. Woohoo! This feels like free money, but remember, it was your money to begin with. You just overpaid your taxes during the year. If the tax you owe is more than what was withheld, you'll have a balance owing, which you need to pay to the CRA by the deadline. Now, how do you actually file? You have a few options. You can still do it the old-fashioned way with a paper form, but I wouldn't recommend it. It's slow and more prone to errors. The most popular method is using CRA-certified tax software. There are many options available. Some are even free. This software guides you step by step, asks you simple questions, does all the calculations for you, and helps you find credits you might not have known about. Once you're done, you can file it online instantly using a system called NetFile. It's fast, secure, and you'll get your refund much quicker. Your third option is to hire an accountant or a tax professional. This can be a great choice if your tax situation is complex. Perhaps you're self-employed with lots of business expenses, or you have significant investments. They can provide expert advice and ensure you're maximizing your return. Filing your taxes is not just a legal obligation. It's also how you access certain benefits. For example, to receive the GST/HST credit or the Canada Child Benefit, you must file your tax return every year, even if you have no income to report. The government uses the information from your return to determine if you're eligible. So, even if you're a student with a part-time job and you know you won't owe any tax, you should still file. You could be leaving free money on the table if you don't. Plus, filing creates a record of your contribution room for things like your RRSP and your tax-free savings account, or TFSA. A quick word on the TFSA. While RRSP contributions are tax-deductible, contributions to a TFSA are not. However, any investment growth and withdrawals from a TFSA are completely tax-free. It's an amazing tool for saving, so be sure to look into it. So there you have it, a whirlwind tour of the Canadian tax system. We've covered why we pay taxes, who pays them, the progressive tax system, deductions versus credits, and how to file. It might seem like a lot, but take it one step at a time. The key is to be organized. Keep your receipts and slips in one place throughout the year. When tax time rolls around, give yourself plenty of time. Don't leave it to the last minute. Use the resources available on the CRA website or through tax software. Understanding this system is a fundamental part of managing your personal finances in Canada. The more you know, the more confident you'll feel and the better financial decisions you'll make. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and hit that subscribe button for more content on personal finance in Canada. If you have any questions, drop them in the comments below, and I'll do my best to answer them. See you in the next video.